We are joined by CEO Sven Silverson. Today, the topic for today, Q2 25, we will go through the result. You will make a short presentation, and then I think we will try and go through the main objectives and the big picture through a lot of questions. So as always, you can ask questions in the box down below. Do it during the presentation, but we will take the main part of the questions in the end. But for now, I'll hand the call over to you, Sven.
Thank you very much, Mikael, and hi everyone. Thanks for your interest in Embla Medical and for being with us here today. I was going to go through just a handful of slides to paint the big picture, and then we'll go directly into Q&A. So we just reported this morning our Q2 performance and year-to-date performance, and overall Q2 was a good quarter for Embla Medical. We generated 7% growth in US dollars, of which 5% organic. We do get a positive impact from the fact that as we report in dollars and the dollar has depreciated, all our non-dollar sales are now worth more in dollars, you could say. So 7% US dollar growth. Our EBITDA margin is 21% here in Q2 compared to 22% in same quarter last year. But if we look at the first 6 months of the year, we're at 20%, up 1 percentage point compared to the first half of 2024. We have also, in relation to reporting here our Q2 figures, we have narrowed our organic sales growth guidance from previously 5 to 8 to now 5 to 6%, and our margin guidance is unchanged. As always, this was an eventful quarter for Embla Medical. We, even though this did not happen in Q2, we did announce last week an investment into Streifeneder Orthoproduction, which is a company that has prosthetics and orthopedic materials and most of the sales are in Germany, but also sales through distribution in a global context. So this is a very good step for us. I'll say a few more words on that on the next slide. Also good news on our Fior & Gentz business, which we acquired last year. Now here in Q2, an announcement of Fior & Gentz being awarded a new L code, meaning that the neurohydraulic knee joint can now be reimbursed in the US, which is a major milestone for us. Also on the patient care front, we continue to roll out our new ForMotion brand, and we've now introduced ForMotion in over half of our patient care franchise. Also, we were happy to be recognized by Forbes magazine as one of the leading companies when it comes to accessibility, as well as receiving the Iceland Presidential Export Awards, recognizing our global impact. Just a few more words on the Streifeneder investment. Streifeneder is as a family-owned business, and just to make that clear, we are only making an investment in their product business. Streifeneder also has a patient care business in Germany that remains with the Streifeneder group and not part of our investment here, but the entity we've made an investment in has around 25 million euros in sales, employing around 100 people, strong in the German O&P market, and this investment enables us to be a more complete provider in a global context for O&P clinics, meaning we now materially strengthen our offering in the value segment of the market, and are also able to offer our clinical customers material and equipment that is used for fabricating O&P solutions. So this is very much complementary to our competitive position in the market and very much in line with our Growth 27 strategy. Just a few words also on regional performance. Starting with EMEA, which continues to deliver solid high single-digit organic growth rates. Americas moved forward here in Q2 compared to Q1, where we were down 1%. We are now growing 3% in the Americas region. And then finally, APAC, solid growth, Australia, New Zealand, but less contribution from our Asia markets, in particular China. But still strong outlook for this region here going into the second half of the year. Michael, I think I'll just pause here and to make sure we have ample time for questions.
Yeah, perfect. Yeah, but let's start with some on the Streifender. Why are you only buying a majority share in Streifender? Is it not hard to get the synergies you want if you don't own the full business as in Fior and Jens? I know what is possible and maybe what is not possible, and maybe getting it to run. But any thoughts? Can you get the synergies if you only own this majority share? And is there maybe other thoughts about Streifender than when you bought Fior and Jens?
As you mentioned, Michael, there's always different situations call for different structures. In this case, this was what we agreed with sellers, that it would make most sense for us to take a first step with as a majority investor in this business, and we have a very clear plan for how we both create certain synergies as well as how we leverage our global reach to drive sales of these of Streifender product and solutions. So this 51% investment achieves these goals here in the short to medium term, and then we will continue to invest and develop the partnership with the Streifender family, and we see significant opportunities to bring their product range to a broader set of customers, and that's our focus here at the initial stage of the partnership.
So there's not so many cost synergies. It's simply like if Fior and Jens to take their products out in a wider range, because
that's correct.
You mentioned they already had distribution agreements around the world, so I didn't know whether you could still leverage your. But is it your patient care you can really leverage here, because they also have not only products but also all the materials that is used there? So is that here where you can really leverage some synergies?
Both on our it helps our patient care business, but also yes, they have certain distribution agreement outside of Europe, but we will bring a much broader access, you could say, for the Streifender product range, and which will in particular strengthen our position in private pay markets where price is often a bigger topic. So this will substantially increase our ability to reach more patients in markets where in private pay markets.
So just to understand it is the lower part of the market that this is covering, where you are not so strong. So that's where it made a strategic fit, that you might not have as many products in these categories. Is that how we should understand?
That's fair. You could say that our Usher business is, you could say, more premium in many ways, while we now have the Streifender portfolio and essentially also the College Park portfolio, which will position us stronger in the value segment of the market.
And then to close that, will this purchase change anything to your current share buybacks? If I understand correctly, it's shares you are giving from your company. So I guess your leverage is staying the same. So I don't guess it will change anything in your share buyback.
No, we should not expect any changes to our share buyback program as a result of this investment.
And then as a question, as I understood you said it's still too fluent, and I understand that totally, to give any impact or a final figure on the impact of the tariffs with the US. But here, there's a question here: does it have any impact on you whether Europe and US gets an agreement, or the 50% goes into what everybody is up in the air on your product category? So just to understand, is the European US, is that the important one, or are your product categories still exempted for the most?
Well, sort of our prosthetics and neuro orthotics business, we believe is exempt or is exempt from tariffs to a very large extent. There are some few exceptions around certain components and maintenance components which fall outside of that definition, but we believe that the vast majority of our prosthetics and neuro orthotics business will be exempt from tariffs. So for us at the moment, the main impact financially is the tariff rate that will exist on imports from China into the US, where we have quite a substantial part of our bracing manufacturing with third-party vendors in China and Southeast Asia, for that sake, that manufacture product for us that we sell into the US market. So that is still the area where we would see most impact here short term around these tariffs. And the reason we're not being more specific about the impact is simply because these tariff rates have been subject to frequent changes. But we are, as we mentioned on the call this morning, we are already incurring cost in relating to these tariffs, and expect more cost here in the second half of the year than in the first half of the year.
Perfect. Yeah, and just to finalize it, to make it totally understandable, I guess nothing has really changed for you, because China has actually been closed. I know it's still up for certain, but that is the main impact. And we talk a lot about pharma. You are not hit by that, as I understand it.
Oh.
You are still in disabilities. So actually, It hasn't changed that much since last time we spoke in
No. It is still the China. Yeah.
I think you mentioned an amount for Q2, and I know that's only a short-term period, and it will be a little bit higher. But did I hear correctly? You mentioned around $500,000 or something like that, and your EBITDA was 47. So I guess maybe we talk a little bit too much about tariffs in your company. Is that correct?
Yeah, I think that's fair to say, Michael. But that. It sometimes becomes a very big topic, but obviously when tariffs were set at 145%, if I remember correctly, that would have been proportionately a bigger impact. But now tariffs have gone down again to around the 30% range. So it's all relative, and we believe also that our competitors are in a similar position as such. So it will impact the whole industry in a way. However, what has not been, or we'll need to see how it plays out, that this will just raise cost overall in the US healthcare system, which is already strained on cost, and it remains to be seen how all these extra costs will be absorbed in ultimately. So this is still a bit. Remains to be seen.
Yeah, but again, it's still your belief that it's the smaller part of your business, and
yes, absolutely. It's it's impacting bracing and support, which is 17% of our business. Half of that business is in the US, so yes, it will impact our numbers, but it's not such that it will totally change our financial profile, even in an aggressive tariff scenario.
And then regarding the guidance, you had around, I guess, 4.5%. You say 4% organic growth in H1, but that must be some, because you have 5 and 4, so it must be 4.5.
Yeah.
going to 5 and maybe 6 in the top end of the guidance. Does something in the market need to change to the better for you to reach the top of this guidance? Is there something you need the market to change, or is it manageable in the current market conditions to reach the top end of the guidance?
Well, as always, when we set guidance in the beginning of the year at 5 to 8%, and we go into the year with a certain set of assumptions based on the trends we see in our business, based on in many years very dependent on obviously our product pipeline, etc. So what we see now after having been through half of the year is that in some areas we're better than planned, and in some areas we're behind our plans. And the main variance from a regional perspective is the Americas. We're doing well in Europe, we're doing well in APAC. And from a business area standpoint, it's mainly our you could say our prosthetics and neuro orthotic business, which is definitely delivering on plan, but we're behind where we thought we'd be in both bracing and patient care. So if we look at the rest of the year, we are expecting higher average growth in the second half of the year than we've generated in the first half of the year, and we believe that that the Americas region as a whole will contribute more to our growth. And the reason we are saying that is that we believe that patient volumes will be stronger in the second half of the year. The way, now speaking in simple terms, the way the healthcare works to a large extent in the US is that there's always some co-participation in overall healthcare cost. And in an environment of uncertainty, all else equal, people will have more certainty on their healthcare costs the further they are into the year. So we expect, and that's this have actually seen here in recent years, that we've seen patient volumes shifting more towards the latter half of the year when there's more certainty on out-of-pocket costs. So we believe that the second half we will have more activity in our clinics, which will ultimately also be the case with our independent clinical customers, and therefore have a contribute to a stronger performance here in the remaining 6 months.
And if I understand you correctly, you have actually seen the trend lines move a little bit up in the latter part of this quarter. Was that correct? So that is your assumptions on.
I mean, if we look at the regional performance, as I went through on this slide here, we see America's region declining here in Q1, but we are growing 3 to. So if you just look at these figures, you see some indication that the market is moving closer to where it should be.
So it's always helpful to see if something should get better. What was then wrong? And we talked about it before we went on. I know it's hard. Has that just been the general uncertainty that has hit people? You know, your patients, out-of-pocket cost, all the talks about what is going to change in the US system. Is that your feel that is what has impacted the market growth, and thereby it's the market who has been a little bit down now, recovering a little bit, and it's not you who has lost momentum compared to your competitors? Is that correctly? Is that how you see the situation?
Well, if going back to just our core purpose and what we deliver on a day-to-day basis in our business, is that we are serving a patient population that consistently needs to maintain, upgrade, renew their mobility devices, and that demand has not changed. There are even aspects like the expanded coverage for low active patients that all else equal should lead to more, you could say, business growth in the O&P industry as general. And we have clear just feedback from also our patient care network that the uncertainty in the overall environment in the US, and also what we see very clearly, slower reimbursement approval processes, also in relation to all these changes that have been implemented with the veteran affairs and and the cost initiatives that have been run by the current US government, these things have been caused short-term disturbance. But what we have though seen here in Q2 is that we see gradually more activity in our clinics.
Perfect. Then there's a question here. Sorry, I need to find that there. The new budget law in the US, will that have any effect on your patient group? I read somewhere where Medicaid and maybe the lower income, which unfortunately often is someone with a disability, might be hit somehow in the new budget. So I know it's very early, but are you seeing any indications there that there is any change downwards due to the new budget bill?
That's a great question. What we understand from this new legislation is that there is likely to be a cut in the Medicaid piece of the overall healthcare system in the US over the next 10 years. Medicaid, we estimate that Medicaid is the ultimate payer for around 10% of the patient population that we serve in our own clinics. Typically, though, these patients will not necessarily receive the high-end solutions. Medicare pays on average, or on average provides, let's say, access to less advanced solutions. So we will have to monitor how this all will impact the market. On the other hand, you see the system sending very clear signals that they are willing to invest in good quality mobility solutions with the expanded coverage for K2 patients, also with this new reimbursement code for neuro orthotics. So it's kind of mixed bag, if you will, and our overall take though on the US system is that we believe we have plenty of opportunity to grow our business and reach more patients that need good mobility devices.
So the new reimbursement, the change reimbursement, that is going to counter some of that potential effect, if I understand you. Is that
that could be one scenario? Yes, that if we have, I mean, there are certain indications that you will have. That again, as was the case before the Obamacare Affordable Care Act was rolled out, you had a population that was simply without any medical insurance. And if I understand these changes correctly, there will again be a population which will be without healthcare coverage. What if there is something else that comes instead? Or there is another path for these individuals to maintain their devices or get access to funding. We'll need to see how that goes.
Then there's a very specific question. I don't know whether you want to answer. How was purchase price finally decided for the 51 of Streifeneder? Will this be made public, kind of a multiple or something like that? Or is that...
Well, I can give some context. I mean, we are paying the vast majority of the purchase price here with the share issuance. So that gives some indication of the valuation for the 51% share. There is a minor cash component as well. But as always, we determine valuation in these cases based on our ability to deliver an acceptable return on the invested capital that is deployed, and it is an agreement with sellers that we are not disclosing the purchase price here, but I can say that from our standpoint we have paid a very fair valuation.
And then on the margin side, I know I saw you didn't mention anything about that. Is that a little bit below or on par with your own margins? Because that is kind of also an indication on the purchase price. So how should we see that business of theirs?
Yeah.
Is it a little bit lower margin business with all the...
Yeah, it's a little bit lower, and we said on the call this morning that it's slightly dilutive, maybe to the tune of 20 basis points ish here in the short term, but in the medium term we expect this business to generate a margin that is on par with at least the average margins in our overall portfolio.
Perfect. And then a little bit up in the bigger picture again, you know, some of your good margin development was cost containment. I think an analyst always need to ask, how long can you do that without that impacting your long-term growth abilities? So a little bit of thoughts about that, because I thought that there's a big reimbursement change in the US, meaning you should train your customers to use that, and you also have a lot of product launches that I think is tracking good, but you could always put more pressure or more selling not pressure, but selling focus on that. So a little bit thoughts about using cost containment maybe in a period where you should push for higher growth in the future. So any thoughts about how long you can keep those cost containment without hurting your long-term growth?
Well, if we look at the three business areas we operate today, prosthetics and neuro orthotics, patient care, and bracing. In both patient care and bracing, we're behind on our top line goals for the year, and we've taken action to adjust our cost base in relation to a new top line estimate for the year. That's the main area where we see where we are you could say adjusting our cost base. However, on let's say the prosthetics and neuro orthotics side, where we do generate a very healthy, almost double-digit organic growth rate here in the quarter, we are making investments. We are continue to make investment to grow that business. But with that still being said, we are from a profit contribution standpoint, that part of our business is contributing very nice profit growth, which is compensating for let's say the negative impact we get from especially the patient care business, which has a larger component of fixed cost, and has therefore a bigger profit impact when we don't generate healthy top line growth. So we are still so it's a little bit different themes per business areas, but right now we don't believe that we are diminishing our future growth potential. We are simply exerting just a very high level of cost discipline to make sure we manage through a period with lower growth than we expect long term in especially patient care.
And then also a little bit up in the helicopter, the bracing and support and the patient care, anything structural changed, something that could affect your abilities to generate your goals for in the medium term goals, for organic growth, I think 5 to 7%. So any thoughts about, is there anything structural there, or are you still seeing it as temporarily and not thereby affecting your potential to grow your medium-term targets?
I mean, if you look at the patient care business, that is ultimately just the same value chain as within our prosthetics and neuro orthotics business. It's servicing patients that have a chronic long-term mobility challenge, and there are no structural changes as such, and we continue to see very, very solid potential in that whole value chain. And that's why we are both, you could say, a product provider as well as a service company that is building a global presence with the ultimate goal of seeing and reaching as many people as possible that need good mobility devices. And it's worth keeping in mind that the relative utilization of good mobility devices remains very low, also in mature healthcare systems. So we have plenty of work to do in that part of our business. The bracing business is subject to a little bit different kind of dynamics. I think the biggest difference is obviously that these are products that are used for a limited period of time, except for maybe our osteoarthritis bracing, which is a very, very strong offering for individuals with knee arthritis as an alternative to knee replacement surgery. But the biggest part of our business is acute care, meaning you have an injury or an elective surgery and you need to recover, and then you will not need the product again. So, but what drives the underlying demand for these products are demographics, are activity levels, and these are fundamental solutions in each and every healthcare system. So So the structural drivers are there, but again, with bracing, the nature of the business is such that it will be more price competitive, but the volume growth drivers are intact. What we did talk about here in Q2 also is that there's a new round of competitive bidding in the US, where Medicare and Medicaid are driving certain initiatives to lower cost for what they believe to be just off-the-shelf standard components. We've been through another round historically of competitive bidding, which did impact our business, although less than what we had anticipated. We still need to see how this round will develop, but we just go back to the fact that we believe that we have at least a competitive cost structure, and that we are just well positioned to deal with these changes, as we have a holistic broad offering of all, covering essentially all bracing needs for our provider customers.
And then second to last question, the Fior & Gentz, you mentioned that they have gotten a new reimbursement code. Is that the first time they get access to the US market? Sometimes, you know, under a small headline, there can be actually a large impact. So can you kind of maybe elaborate a little bit on whether that is actually could be a substantial impact? I know not tomorrow, but in the future.
Yeah, I mean, the reason we made the investment to acquire Fior & Gentz was that we believe that this is a patient population that we should and can serve better. Fior & Gentz has mainly built their business around the German market and in certain European jurisdictions. And again, just as a reminder, serving people that have lost the ability to use the muscles in the lower part of the body as a result of stroke, cerebral palsy, and some neurological complications. Now, reimbursement is generally healthy in some of the main European markets, but reimbursement levels are very low in the US, and you have and generally these types of devices are fairly low end. So now with this new reimbursement code, we see a signal, and you could say confirmation from Medicare that they understand the health economic benefits of providing these types of solutions for this patient cohort. So we are extremely happy that we have now taken this step, and we see big potential in the US longer term. This will have not a significant impact here in the short term, but in the medium long term, this is just a start of really building this neuro orthotics business also in the United States, which is the biggest healthcare market globally.
And as always, the final question, and I know it's not a nice subject, but your outlook expectation for the Ukrainian market. We have had this subject up a couple of times, whether that's unfortunate war is impacting your growth expectation or something like that. So a little bit about that.
Yes, I mean, we are one of the big global companies in this industry, and we have made a big effort in Ukraine, both in terms of training new prosthetists and finding ways to get amputees using adequate prosthetic solutions. Now, the biggest challenge in Ukraine from a prosthetic standpoint has been simply the lack of simply not enough experience in the whole value chain to fit the number of people that now need prosthetics, and that's going to take years. And we are certainly making as much of an effort as we can to contribute and help. We've donated lots of both, you could say, time, especially effort around education to educate and bring prosthetists. New prosthetists into the field. So this will be a market for us going forward, but I don't expect this to necessarily change the big picture for us as a company. But it's certainly a situation where we are focused on contributing as well as possible.
Perfect. I think that was all the questions we had from the audience and from me, Sven. Thank you for taking us through your results and answering questions. May everybody